Hello everyone, and thank you for tuning into the North Main Minute. I'm Joshua Doby. A very fundamental planning question, and this is often a part of the first meeting together or the first discussion as we're talking about setting up a financial plan or maybe tweaking or adjusting a financial plan, is the broad idea of risk tolerance. Now, you may or may not have heard of that particular phrase of risk tolerance before. Many of you probably have. Maybe you know what it is. Maybe you're a little bit curious as what exactly is risk tolerance? Well, let's talk about that for just a moment, give a little bit of definition to it. Risk tolerance, generally speaking, is the tolerance or your ability or desire to absorb movements in the market in this particular instance. Meaning, are you okay, and I'll put that in the proverbial air quotes, are you okay with a certain amount of, in most instances, negative volatility? And sometimes we put numbers to it in order to quantify it. Are you okay if your portfolio pulls back 5% in a negative market? Are you okay if it pulls back 15% in a negative market? Are you okay if it pulls back 35% in a negative market? You see where I'm going there. You may have said, yeah, I'm okay if it goes down 5. No way am I okay if it goes down 35%. Well, that begins to give an indication about risk tolerance, meaning that sometimes those things that go down 35% are also the things that can grow at much faster speeds over time as well. So it's that balance that's out there. It's that understanding about how the market moves and what is your desire or appetite to absorb that risk. So it's very, very important to keep in mind when we're thinking about a definition, your appetite, desire, ability to be able to absorb risk. Usually we're talking about it in a negative way, meaning how is your ability to absorb that negative risk. So all right, we have a definition on it here. How do we manage it? Well, very broadly speaking, one of the ways in which we manage it here at North Main Financial Group is through diversification. And to give you a 10-cent phrase, we use a basket of non-correlated assets. All right, what's that mean? What that basically means is we don't want everything moving in the same direction at the same time. We want things moving in different directions at the same time, meaning that as something is positive, something else is negative. And then at another time, that may be in the inverse. That's what we want to have happen so that not everything is coming down at the same time. That's not diversification. That's owning something, again, that is perfectly correlated and not something that's helpful in a time of negative volatility. So diversification is one of the primary ways to adjust that. Third big item to keep in mind, if you're looking at getting a better understanding of your risk tolerance, perhaps even making tweaks to your portfolio to adjust to what that true risk tolerance is, do it when it's not in a negative market. Let me say it this way because it happens all the time. When the market has gone through a significant negative space, and let's say your portfolio had a lot of risk, maybe you didn't even understand it, and it has pulled back significantly, folks, that's not the time to get conservative. All you're going to do is lock in your losses there. Does that make sense? I'm looking at it mathematically. So if you were taking a lot of risk, and things have pulled back a lot, 20, 30% more inside of your portfolio, if you get conservative there, folks, you may not recover back to where you were, or it may take a very, very long time to recover. We see this in every market downturn cycle. Folks get scared after things have pulled back. They start thinking in straight lines. They think it's going to go to zero. They get very, very conservative and they say, well, at least I stopped losing money. That's true. But in terms of recovering back to where you were, that may or may not ever happen again. So very important, if you can, make those adjustments and get a good grasp on risk tolerance before the market pulls back negatively so you can make the best tweaks to your portfolio. If you'd like to reach out to us at North Main Financial Group, perhaps walk through your risk tolerance of your portfolio. Get a second, third, fourth set of eyes on it. What do we think may be inherent in there? Maybe some things you hadn't thought about in order to prevent some downside losses in the future. Feel free to reach out to us, northmainfinancial.com.